candle of the day. It's mainly based on first candle of the day. If you see a big bearish candle like this, first 5 minutes red candle, then it is a candidate for this pattern RCR. Sometimes you see it, right? Market opens with a big bearish candle and you think that, oh, today market is looking bearish, I will take a short trade because market will go down. But instead of going down, you see that market is going up, right? Red candle looks like bearish, but instead of going down, it is going up, and you'll get confused what's happening. So that is why you should always remember, don't go short just because it's a red candle. When you should go short, that I'm going to discuss also, when you can short. When you should short this red candle, when you should not short, both I'll discuss. Remember, whenever you see a big red candle, that means this is the big sellers, right? This is your supply zone. The top of that red candle is a supply zone, okay? That is the supply zone on smaller time frame. Supply zone, yes, I told you that supply zone means market goes up and suddenly crashes, right? That is what first session we said. This is the supply zone, top of that place where crash happened. Again, on smaller time frame, daily time frame also, if market opens with a huge red candle, this is your supply zone. You should look for this level. That is where people have the stop loss above that supply zone. People have the stop loss above this. Big sellers who shorted this candle, they have the stop loss. And many times you'll see that instead of going down, it keeps going up, going up, going up. It goes almost to the high of the red candle and reverses. You can do some back testing on your chart. Look at the chart in Nifty, Bank Nifty. Whenever first red candle, whenever day's first candle is a red candle, look at such candles and you see most of the time it goes almost at the day's high and reverses. If the day's high of the red candle inside the CPR, then it's a very high probability trade. So that means next time you will not short here, no shorting here. Where you will short? You will short here. That means once it comes back to the red candle high, now you can short, not here. Because if you short here, where will you keep your stop loss? Will you keep such a big stop loss? Short entry here, stop loss here. Look at this, how big is stop loss? Here shorting here would be good stop loss. Here shorting here would be good risk reward because you can keep your stop loss above the CPR and take profit back to the swing low. Swing low is this. Your stop loss would be very small. So that is what trading is. Why it works, why this pattern works most of the time? Because when you short here, this red candle high is a resistance. Why? Because people have stop losses that they will not allow you to come and take their stop loss so easily. Once they see that you are coming near the stop loss, they will again push the price down. So that means this is the place where resistance. Second thing is that I said if it is inside the CPR, high probability, right? CPR itself is a resistance, so there is a double resistance. One is CPR resistance, one is this red candle high. So shorting here is a good opportunity. But I told you that not short red candle just because it's red. But sometimes you can short red candle. When you can short, suppose day opens with a big red candle like this and day had a narrow CPR. If that day had a narrow CPR, most of the time you can take short trade. Even though stop loss would be big, in that case you can keep your stop loss somewhere here, half of the candle, and you'll see price keep going up. Why most of the time it works? Because narrow CPR means likely trending day, right? And you can see market is going down, so there will not be any RCR, nothing. There will not be any retracement most of the time. Sometimes you will see a big red candle, and if there is a wide CPR instead of narrow CPR, in that case it's never a good decision to go short expecting market to go like this, because wide CPR means it stays sideways. So in that case you can short here near the high of the red candle. Don't go short. That is what RCR or red candle retracement pattern. You can see here on 23rd market opened with a huge red candle, then there was some bearish candle, took the support near the daily pivot, went back to the day's high. This is the place you can short. You can place there, you can keep your stop loss here above the CPR, take profit back to the day's low. So that is what I said. Never short this red candle just because it's red. Look at the CPR, wide CPR. That means it is likely to stay sideways. And most of the time you see that there will be a bounce back to this red candle. Now you can short because above that red candle there is a stop loss. So that will be resistance plus wide CPR. You can short and keep your stop loss here. You can see that second time again price came back to that same red candle high and it reversed. But I will not be interested to short here. I'll be interested to short here because this pattern, red candle retracement, high probability patterns in the opening to mid afternoon, not a high probability in the late afternoon, because breakouts are common in the late afternoon. Retracements are common in the mid afternoon or opening session. Remember that. Look at this one, 9 wide CPR, market opened with a red candle, and then what happened? Instead of going down, it started going up. What you will do? Once price comes back near to the high of red candle, you can short, keep your stop loss, take profit back to day's low. And you can see what happened after that afternoon breakout, right? Afternoon retracement didn't happen. It started going up. That's why you remember I said late afternoon breakouts are very common. Look at this. Here also you can see that late afternoon breakouts are very common. Okay, green candle retracement is opposite of red candle retracement. Same, first candle will be huge green candle. Like how I said RCR, how I said for RCR, first candle red mean don't go short. In GCR also, don't buy here just because it's a big green candle. Don't expect market to keep going like this. Yes, sometime it can happen, but not always. So it is best place to wait for price to come back to the day's low. Once it comes back to the day's low, look for the bullish candles and then you can go long. Entering here is the best trade, not entering here. Why? Because same thing, how I said RCR mean high of that red candle is a supply zone. This is your demand zone. This is the demand zone. That's why you see that big green candle. People have the stop loss here. Once it comes near the green candle, you can expect it to again bounce back to the day's high. Don't go long here. Wait for price come back to the day's low. This is the candle you can enter. So there is no 100% in trading. I said earlier also, right? If you go long here, there is nothing like 100% it will bounce and goes up. Anything can happen in trading. It can reverse and it can fail. But if it fails, how much will be your loss? Your loss will be only this much because your stop loss here, entry was here. Same time, if you entered here and you kept your stop loss, look at this. How big is your stop loss? That is what I said. Trading is not about trying to make profit every minute or every hour. It is not possible that every setup you can make profit. There will be stop losses in between, but trading is more about losing small whenever you are wrong. That's what I said in the first session. You should focus on preserving your capital and focus on the risk. You should focus on the risk. That is what professional traders do. Professional traders focus more on the risk. They will take entry in such a place that even though that trade doesn't work, their losses will not be big. Professional traders enters here and keep his stop loss here. Novice traders enters at the top and trade with such a big stop loss. So you need to have patience to price come back to the first candle low if it is bullish. Another thing, remember, okay, sometimes it may happen that first candle is not exactly like this, not exactly bullish like this. Sometimes you may see something like first candle is like not very bullish, medium to average body. Second candle, medium to average. Third candle, medium to average. Still, you can consider as a GCR. So candle doesn't have to be big like this. Even medium candles also will do, provided there is some follow-up. Okay, there is a follow-up mean back-to-back green candle. Still, you can consider these three candles as a one big green candle. Or sometimes you may see pin bar, not a full body candle like this, And after that, if market goes up, comes down, this is also GCR. Not necessary. It has to be exactly like this. Okay. All this PPT, whatever I mentioned, shown here, this is for just like a image illustration purpose. This is not that exactly candle has to be like this. Somewhere near also fine. Day opened with a huge green candle, but there was a daily pivot, there was a weekly pivot. It started facing resistance at the weekly pivot. It came down all the way back to the day's low, bullish pin bar. This is right. Now you will go long on this candle, keep your stop loss here, and you made a profit. What novice trader would have done? Novice trader must have went long immediately at that green candle, and he must have kept his stop loss below that green candle. His stop loss hit. He entered here, stop loss hit. Professional trader shown his patience for price to come to the day slow. He must have entered here. He must have kept stop loss. That is why in trading, patience is important. Okay, green doesn't mean you have to buy immediately. Okay, wait for the retracement. This is the best place to enter. Look at this, another big green candle. Don't enter. Let price come back to the green candle low. This is the best place to enter. For example, don't go long here. Wait for price back to the first green candle low. This is the best place to enter. And you can see there is a double confirmation. What is the confirmation? Can you see there is a virgin CPR? So that virgin CPR also your support, right? So this was the best place to go long. And you can go long here. Maybe you can keep your stop loss here. You can go long somewhere in this pin bar. You can keep your stop loss here and take profit when price goes back and meets the day's high, first 1 hour high. Okay, let me show you another thing. If you are thinking that every time big green candle mean 100%, it will come back to the day's low, it will make a pin bar, bullish candle, you can go long. That doesn't happen. Market is not here that to oblige all of us, right? Market will do on its own. We need to change ourselves to market behavior. We can't expect market to come to where we want to enter. But that doesn't mean that you should chase the market. For example, what happened on 12th, you can see big green candle. You thought it will come down. Instead of coming down, it immediately another green candle. It broke the daily pivot, kept on going up, and you missed the opportunity, right? There is no GCR also on 12th because it didn't come down. Many novice traders, what they do, they get upset that they miss this much opportunity. They think that market will go up and I missed the opportunity. They go and buy at the top only to see market reverse. It's the stop loss. Look at this. That's it. Around 10:30 or around 10:30, you can see that it kept on going up. After that, till 3:30, it was a sideways. Nothing happened in the market. So that's why next time, don't chase. Okay, you don't have to chase. Your entry, you decided your entry was first candle low because it was a demand zone. Why it's a demand zone? Look at the move. Huge move. Demand zone. So there is no trade on 12. Professional traders, they don't force a trade. Day trader doesn't mean that you have to trade every day, morning 9:15 to 3:30, you have to keep taking the trades. Nothing like that. Okay, day trading doesn't mean that every day you have to trade. Full-time trader doesn't mean that every day you have to trade. Only trade when you see setup, good setup. Okay, that is what professional traders only trade when they see high probability pattern, high probability setup. 12th, there was no trading opportunity at all. So you should not have traded on 12th, even though market went like this. Because you should know that market will be there next day also. Next day again market opens. Again you can take the opportunity. There is always a tomorrow in the market. So what you should do? You should go and mark the level that first candle low, right? That was the GCR where you were waiting for price to come here. 12th it didn't come, but what happened on 13th? Can you see? 13th it came here, took the support and started going up. So that is what GCR is not only applicable on the current day, it is applicable also if previous day had a big green candle. Okay, that you should remember. RCR also not applicable only on the current day, it's applicable even next day. Next day if price comes back here, that also you can consider for RC. Okay, now we'll discuss about a pattern called gap up rejection pattern. Gap up rejection pattern is nothing but gap filling strategy. You remember we discussed about gap filling. Markets don't like gaps. most of the time gaps get filled. That's what I discussed in first session, right? So this is the gap up rejection or a gap filling strategy. What is the gap? You can see here, previous day high and next day first candle, right? So this is the gap. So what you will do next time, whenever market opens with a big gap up like this and it makes a bearish candle, you know that there is a gap. Chances of gap getting filled higher. You can immediately short that red candle. You can keep your stop loss above that red candle. Let price come to the previous day high. Once gap is filled, you can book your profit. Okay, this somewhat looks like a evening star pattern, but only difference is evening star pattern candle will be red only, gap up only, but in evening star pattern candle will be very close to previous day high like this. Hardly there will be any big gap, but if there is a big gap, then it's a gap up rejection pattern. If there is no big gap, then it's a evening star pattern. In the evening star pattern, I said you should enter once previous day high broken, take profit at the CPR. In this pattern, you can short here, take profit at the previous day high. In this gap up rejection, take profit at PDH, not at the CPR. But remember another thing, this pattern is not very frequently happening pattern, okay? Because gap up, gap down, you should know that this doesn't happen every second day, right? Gap up, gap down, big gap up, gap down, small can happen. Like a huge gap up, gap down happens normally when there is a overnight news in the market. If there is a positive news, there can be a big gap up. Negative news, there can be a big gap down. But you know that positive news, negative news like that, it doesn't come very frequently, but once in a while it can come. So whenever it comes, you can see this kind of patterns, and when it happens, now you know that how to trade. For example, you can see that on 9, it opened with a big bearish candle, right? Gap up but bearish candle. Where is the gap? This is the gap. Previous day high is the gap, and you can see that it came all the way, fill the gap, and look at the bounce. Immediately big bounce. So this is the place you should take the profit, not CPR. It is true that after that afternoon it came and broken that gap border, came at the CPR, but take profit here because gap borders are one of the important support resistance which we had discussed earlier. So shorting here, stop loss here, take profit here. Remember a couple of things. This bounce not just because previous day high. So there are some support resistance major, some are minor. For example, PDH, PDL are minor, not the major support resistance. Daily pivot, weekly pivot are minor. What is the major? Are supply zone, demand zone, swing high, swing low on the daily time frame I'm talking about. All these are very powerful, even gaps, powerful support resistance, major. But sometimes PDH equals to supply zone. PDH is also supply zone, or sometimes PDL is also demand zone. That means both are same. That time PDH, PDL can be very powerful, or PDH also equals to gap border, like you can see here. This is not just a PDH, you can see this is also gap border, right? So that time it becomes very powerful. What I mean to say, PDH equals to supply zone, that means if Monday market opens, goes up, suddenly big crash, okay, and finally market closes here. This is not just a PDH, this is also your supply zone. So in that case, this is your very, very powerful level. Or sometimes you may say market is coming down, and suddenly market bounces. So this is not just a PDL, this is your demand zone also. So that is something you should remember. For example, next day, this is not just a PDL, this is the demand zone. Look at the bounce. Remember that. When PDH, PDL important, when it is major, when it is minor support resistance. Look at 19th, market opened with a big red candle, short here, stop loss here. This is not just a PDH, you can say it's a supply zone also because there is a crash, right? It took the support and then started going up. So you could have shorted here, take profit here, not here because it's a gap. Gap borders are important support and resistance. Now we will discuss about a pattern called CPR breakout pattern. What is the CPR breakout pattern? CPR breakout pattern is based on current day CPR. In breakout, there are two types of breakout you can see. One kind of breakouts are like this. When you see this kind of breakout, this is known as parabolic breakout. Parabolic breakout means non-stop big red candles without any consolidation. You should never short here if you see this kind of parabolic breakout from the CPR. Okay, don't short. When you should short, this is your CPR and you see that big red candles, it comes inside the CPR, then make some consolidation inside the CPR and then breakout happens. This is the one you can short because there is some consolidation. Okay, so that is what known as CPR breakout after consolidation powerful. Non-stop parabolic breakouts are not powerful. Another thing I mentioned, for CPR breakout there should not be any candles on the left on same day. What I mean by that, for example, you see that market opened with a red candle, okay, then made some consolidation and breakout. Now you can short here. Okay, assume that after that it kept on going down and you booked your profit here, then market again started bouncing. Okay, assume that it started bouncing and again it went above the top CPR. Is it a breakout now? This is not a breakout. This is the breakout. Why? Because breakout means there should not be any candles on the left on the same day. If there is any candles on the same day, that means there is a support. For example, this you should not take. Look at the left of that candle. There are candles. So these candles are likely to work as a resistance. So no going long here. Okay, that you should remember when you take CPR breakout, because many people get confused with that. Look at this on 8th. This is a evening star pattern, right? Big red candle, broken the previous day high, short here, take profit at the CPR. Then there is a small consolidation, then breakout. Now you can short here. This candle you can short because there is a breakout after the consolidation. For example, look at this. Consolidation huge, almost like 9:15 market opened till almost close to 2 o'clock. You can see that I think 145, 150, there is no pattern at all. Such a boring day, and suddenly around 145, 150, big green candle, breakout from the CPR after the consolidation. Now you can go long because breakout after a big consolidation. And remember this pattern, breakout patterns and all, you should enter only at the candle close. Okay, don't enter before the candle close. Always wait and enter at the candle close. For example, you can see here also breakout, but this is not a good breakout. Why? Because there is no consolidation, and you can see sell-off started from here and you are shorting here, right? Because people who shorted here, they may be interested to take their profit now because already they have made good profit and you are entering at the late. But here if you enter, you entered at the first breakout candle, high probability. And remember, this is your supply zone. Why this is a supply zone? I also said when market is going up bullish, if suddenly crashes, that is your supply zone. So what you will do, you will go mark that level on your chart, and next time price comes to this level, that is your strong supply zone. Okay, now let us discuss about the next pattern, that is gap down rejection pattern. As I said, gap up rejection pattern is not very frequently happens because gap up doesn't happen every second day, right? Whenever there is some positive news or negative news, then only you can see gaps. Same like gap down rejection patterns also doesn't happen very frequently, but whenever it happens, you should know how to trade it, right? So we'll discuss this pattern called gap down rejection pattern. The difference between gap up rejection and gap down rejection pattern is, in gap up rejection pattern, if you remember, it was a gap filling strategy, right? So I said if market opens with a big gap up, makes a bearish candle, you can short, and once that gap is filled, you can book your profit. So that was the gap up rejection pattern. Gap down rejection pattern is stop loss hunting pattern. This is the stop loss hunting pattern. That means once gap gets filled, once that gap border is broken, I will go long on this candle. The candle which broken that gap border, I'll go long. Okay, this is my entry candle. Look at this. On 25th, there was a gap down, right? This is the gap down. 24th low was here. 25th market opened with gap down. Now, where is that gap border? This is the gap border, right? This is the one border, upper border, and this is the lower border. And this is the gap. This is the gap. What I said, markets don't like gaps. That doesn't mean that gap has to get filled same day, right? Look at the 25th. There was no effort to fill the gap. Market stayed sideways for the entire day. Entire day market was staying sideways. But 26th, what happened? Just look at it. Look at the first candle, huge bullish candle. It broken that gap and it broken that daily pivot. Second candle broken daily pivot. Next pivot also broken. Where it went all the way here, gap border, and gap got filled. Gap got filled. Can you see that? How market have the memory? That's why they say market have the memory. Sometimes it can be so precise as if somebody drawing the lines. You can see that broken this gap border, where it went exactly point to point. It went, faced resistance, wicks went above it, candle close right at the gap border, and then what happened? Reversed. So it went as if there is a mission to fill that gap. It filled the gap and came down, and then again it started going up, going up, going up. Again it started facing resistance near that gap border, and finally breakout. This is the candle I said I will go long. I will go long on this bullish candle once that gap border is broken. First time gap didn't get broken, right? Gap border could not be broken. It got reversed. You may say that, oh, here gap border broken. Look at this green candle that closed above that gap border, right? Black dotted line. But remember, this is not a breakout candle. Why this is not a breakout candle? Because remember, in trading, this wicks also very important in trading. This wicks, especially near to the some resistance or some support. Okay, so that means even though this candle wicks went above it but could not close it, right? This candle where it faced resistance exactly at that wicks. Right now, which is the important wicks? This is the important wicks. This is the important resistance. Until that wicks is not broken, you will not go long. Look at this candle. Even though that candle wicks went above it, but where is the close? It could not close that wicks. It could not break that wicks. So that is what, it's not a breakout. It's not a breakout candle. Okay. Next candle also you can see pin bar, but even that candle could not break it. Now this is the important wicks. Okay, this is the important wicks, not this. Now this is not important. Now important is this, because this candle is above it. Next candle only went till here. Can you see this red candle? It went all the way near that wicks and faced resistance. That is what you should remember in trading. This wicks and all very important. Until these wicks are broken, it's not a breakout, even though this candle went above it. Now let us see what happened. Look at this consolidation and then a big breakout. And look at this candle. Where was the wicks? This was the wicks. Can you see that? This candle broke all the wicks on the left and then started going up. So that is what I said. This is the breakout candle. I'll enter this candle once gap border is broken. Okay, this is the candle I'll enter. And I can keep my stop loss here below the candle. This is called short covering rally in trading. Short covering rally means short sellers got trapped. They got trapped, so that means all their buy orders started getting hit. If you apply the logic, what could have happened? 25th, the market opened gap down. Whenever there is a gap down, people have tendency to think that gap down means now market has to go down. That is what retailers think, that gap down means it has to go down. And gap border is the place where people normally have the stop loss. This is the place they have stop loss. That's why gap borders works very well most of the time. Stop loss is nothing but buy order, because there are short sellers here, right? You can see that market is not going down, instead going up, and maybe there are other short sellers joining in when they seen that again market is coming down. Everyone have their stop loss here above that gap order. Can you see first time they were successful in pushing the price down, right? These people who short sellers, they push the price down. Second time again they tried to push, but they were not successful because they could not take it down. Buyers were trying to take it up, and finally one big bull candle came and all stop losses got triggered. There was a big buy order here, and one after another started getting triggered, leading to this massive rally. So that is what known as short covering rally. That is what happens in market. And you can see that even there was a virgin CPR, even that broken easily. There was no resistance at all near the virgin CPR. Anyway, that I told you that virgin CPR is not powerful at late afternoon. It works best at the opening session. Again, even though if you want to short, don't short just because it's at virgin CPR. You need some bearish candle confirmation. There is no bearish candle because this is a short covering rally. All short sellers are in panic to cover their position. Some people don't have tendency to keep stop loss. They think that, oh, market will come down, market will come down, market will come down. But market is not coming down. Their losses are becoming bigger and bigger. And finally, they have to cover their position. That again leads to this rally. That is what known as short covering rally in trading. Look at this 26th. Market opened with a gap down, right? Where is the gap border? This is the gap border, previous day low. You can see that how nicely price started facing resistance at the gap border and immediately reversed. Can you see that? Almost it came to the day's low, again started going up, again started going up. First time it got rejected from the gap border. Short sellers were successful in pushing the market down. And then there is a small consolidation. Consolidation near the important resistance, that means chances of breakout here. And this is the candle I will enter. I will go long on this candle once that border is broken, gap border is broken. I'll go long here. I'll keep my stop loss below the gap border, take my profit at the CPR. Again, what I said, wicks is important. This wicks is very important. Until that broken, you should not have gone long. Let us see whether it's broken or no. Yes, that wicks was broken means it's a breakout. Now you can go long. Instead of that green candle, assume that there was a green candle like this. Okay, closed above that gap border, but did not close above that wicks. This candle you should not go long. Okay, this candle you should not go long because it is still below that wicks. That's what important point to be noted. Now let us see what novice traders, what mistake they do. They don't look at the location, nothing. They just look at the candlestick. They think that bullish pin bar means one has to go long. They think that I have to go long here, right? They will take a long position, thinking that market will go like this. They'll keep stop loss somewhere below that first candle. And what happened? It reversed, finally stop loss hit. Stop loss hit for a novice trader. But a professional traders, what they do, they don't take long trade here because they know that there are resistance. So they will wait for price to come to the day's low. Once they see bullish candle, they'll go long. So which pattern you can see here? GCR pattern, right? There was a GCR pattern here. Going long here is a best trade by keeping your stop loss here. Going long here was the best trade, not going long here. Because if you go long here, till the next pivot, there is no resistance, right? So that means there is a very high chances that price can go till the next pivot. So that is what trading. That is why you need patience in trading. Not going long immediately the moment market open. Wait for price to come to the day's low where you can enter long. So you book your profit here if you have entered GCR pattern here. Then you wait for the gap down rejection pattern. Again, you see that there is a breakout, and now you go long here also. So one long entry was here, second long entry was here. Why I say you should not have entered long here only? Because you don't know, right, whether this gap border gets broken or no. You don't know. You can't trade what you think. You should trade what you see. So that is what you see here, that breakout happened. Now you can go long here. Okay, this is what gap down rejection pattern. Now we'll discuss about a pattern called M reversal pattern. M reversal pattern, something you may see very regularly, because this is nothing but again based on supply zone. That means in this pattern what happens, market opens bullish, keeps going up, keeps going up, keeps going up, and suddenly it crashes. This is not a crash. This is not a crash. This is all called as a retracement in trading. That means it will have a higher lows. Okay, crash mean like this. You can see that suddenly it crashed, collapse. So now this becomes your supply zone. If price comes back to that supply zone, you can take a short. Look at this. 13, there was a big gap up. Which pattern this? Which pattern is this? OD pattern. Remember, OD pattern doesn't mean that first candle has to be strictly above the PDH. It should touch the PDH. Nothing like that. It has to be above PDH. Not necessary it has to touch. Okay, this is also OD if candle is bullish and above the daily pivot. So you will enter here in this bullish green candle because there is a support and candle is above PDH, bullish candle, and there is a room to move. So this is a OD pattern. You can see that it started going up here, then a small retracement and a crash. This is not a retracement, this is a crash. Why? You look at this, almost it came back to the day slow, right? From the day slow it bounced. So this is your place where you will go short here, because from here it crash happened. So that means it's a supply zone. Now you can short here. Okay, this is the M pattern where you can short, and you can see that it was a OD pattern. This is a GCR pattern also. Why this is a GCR? You can see that price came back to the day slow. First candle was a bullish candle, took the support and bounced. Okay, so there are three patterns: OD pattern, GCR pattern, M pattern. You can see this is also your M pattern. Okay, OD pattern also. OD went up, retracement, now it's a crash. Till here it was a retracement, crash, because it came all the way back to the day slow. So now this becomes your supply zone. When price goes back to that supply zone, you can short. Again here also OD pattern, GCR and M pattern. W reversal pattern is opposite of M reversal pattern. If M reversal pattern was based on the supply zone, W reversal pattern based on demand zone. That means if you see market is coming like this, then this all pullbacks. These are minor pullbacks. Demand zone means if you see a big bounce from one particular level. So this is your demand zone because of the big bounce. If price comes back, retest that low where last time bounce happened, you can think about going long because it is likely to work as a demand zone. This is what W reversal pattern. Look at this. It came here, market opened with a bearish candle, came here, took the support near the pivot, went all the way to the top CPR, crashed back to the same here demand zone, right? This is the demand zone. It started making base here, then big bounce. So this is the place you could have gone long. That is what W pattern. Look at this, big red candle started coming down, suddenly big bounce. Next time when price came back to that day slow, now you can go long. Okay, don't just go long because it came to the day slow. Wait for some green candle or some pin bar or confirmation candle, bullish candle like that. So this is the candle you can go long. So now we are coming to the last but one pattern. Let us discuss this pattern called red candle breakout pattern. This pattern happens very frequently and most of the time tend to give huge profit because it is a stop loss hunting pattern. Stop loss hunting pattern tend to give huge profit because of the trap traders. Traders are trapped, right? Retailers are trapped, novices are trapped. But remember, any pattern what I have discussed till now Don't be under impression that it's 100%. Okay, any pattern can fail. That's why you will always see mentioning stop loss. That means no 100% that will work. If it doesn't work, then be ready to take your small loss. That's why stop loss is kept. That's why all patterns I must have mentioned this stop loss. Okay, now what about this pattern? This pattern looks like a RCR only, because first candle opens with a big bearish candle. What I said big bearish candle means what? It says supply zone also, and people have the stop loss here. What is the stop loss? Buy order. Okay, there is a buy order here above that red candle. And what happens here? Market, instead of going down, it makes a sideways, and suddenly one big green candle comes and breaks the high of the red candle. So what happened? People who had the stop loss here, all stop loss, that is the buy order, get triggered, and you can see huge movement on the upside. So that is what red candle breakout. That means it's a trap. Looking at this red candle, people think that market will go down, but instead of that, it reverses, hit the stop losses. All people who had the stop loss here trap. So that is the difference between RCR and RCBO. RCR, I said market comes back to the red candle and reverses. RCR high probability whenever there is a CPR along with the red candle. Most of the time you can see reversal. But RCBO high probability when there is no CPR. So if there is no CPR and breakout happens, it's a high probability. When you should avoid red candle breakout? Only whenever there is a CPR. If you see that red candle breakout happened and immediately there is a CPR, then it is best not to go long here. Okay, because there is a CPR, and CPR can act as a resistance. It can reverse, your stop loss can hit. But if there is no CPR, if there is a daily pivot, or if there is a weekly pivot, or if there is a previous day high, all these minor resistance can be ignored and still you can go long. Only if CPR, you should not go long, because CPR is very powerful, especially if it is wide. Look at this. Look at this on 6th, market opened with a red candle. It broken the previous day low also, but can you see that there was a daily pivot, there was a weekly pivot, then it started making base here, right? And look at this. One big green candle, another big, and look at this. This is the candle, took all the stop losses where people had stop losses here. After that, just look at the move. Huge move on that day. That is what known as stop loss hunting or RCBO pattern. So I'll go long here. Once breakout happened, I'll keep my stop loss here below the CPR, and I can make big profit. Just look at the price action. Look at the entire day price action. Which is the biggest green candle? Can you see? Biggest green candle is this, right? This is also big, but you can see that this is the biggest, you can say. Why this is the biggest green candle? What could be the reason that this is the biggest green candle? Because this is a stop loss hunting candle. This is the candle which took the stop losses. That means there was a big buy order above that red candle. So that is what happens. If there is a big buy order, mean candlestick also becomes very big bullish because of the liquidity, because of the buy orders. So that is what red candle breakout all about. Look at this. Market opened with a bearish candle, but immediately there is a daily pivot. There was a candle taking support here, and people who thought market will go down, who were shorting here, and once stop loss triggered, all buy order got triggered. All buy order got triggered, and look at the huge move. So that is what, again, look at the here price action, which is the biggest green candle. This is the biggest green candle. What is the reason? The reason is people had the stop losses here, and all the buy order got triggered. So since you know how to where to enter, you will enter here. In all these breakout patterns, you have to wait until candle close. Okay, you have to wait for the confirmation candle. That means candle has to close. But only thing is that if you wait for candle close, your entry will become here. In fact, breakout happened here, your entry will become here. That you can't do anything, because this is breakout, means you have to wait. But only thing is that you don't have to keep your stop loss here, you keep your stop loss here, so that you don't have to keep very big stop loss, because you can keep stop loss below the PDH. So that is the difference. What novice traders do, novice trader immediately go short thinking that red means it will go like this, but you will not go short because there is a daily pivot below that candle, then there is a previous day low, right? So there are two support. You will not go short. Instead, you will see whether there is a RCBO. RCBO happened, you go long. How I said GCR, RCR applicable on the previous day first candle also. RCBO also applicable on the previous day first candle. This is 14th, right? Market opened with a huge red candle. Look at the CPR, such a narrow CPR, right? Narrow CPR means what I said, likely trending day, and there may not be RCR. RCR likely happens when there is a wide CPR where likely sideways market. So you should not have expected it to come and become a RCR because CPR was very narrow. And what happened? Immediately after that, immediately big trend, right? After that, market went into sideways move, but you can see that from that red candle, it kept on going. And one of the reason could be CPR was very narrow. Okay, now what happened on 15th? Okay, people who shorted this big red candle, you know that where they have the stop loss. They have the stop loss above that red candle, right? They have the stop loss here. Next day, what happened? Small red candle, small green, then what happened? That's it. Game over. All people who had the stop losses here, that was the buy order. All short sellers buy order, that is stop loss got triggered. Huge green candle, small retracement, and look at this. Finally, market closed at 330 here at the high of the day. That is why RCBO, I said, most of the time it can give you good move. Okay. Again, here also, if you look at the price action, 915 to 330, this is your biggest green candle. What is the reason? Because there are stop losses. So that is what I say about the price action. You need to learn price action. Why that candle is very big? What could be the reason? So that is what price action will tell you the story on your chart. Where are the buyers? Where are the sellers? Why that big green candle? Because they had a stop loss here. So that is what I always emphasize on, learning price action rather than depending on indicators. Finally, we are coming to the last pattern of the day, green candle breakout. So this is the 15th pattern. This is also one of the breakout patterns, stop loss hunting pattern. Just like red candle breakout, in green candle breakout, same thing, market opens with bullish candle. Instead of going long, it reverses, and once first green candle low gets broken, people have the stop loss here. What is the stop loss now? Sell order, because people were long here, and this is the candle you will short. Once that green candle low gets broken, you will short. On 14th, market opened with a huge bullish green candle. Look at the size of the candle. And many people thought it will go like this, but instead of going up, it reversed, and people had stop loss below that green candle somewhere here, and this candle took the stop loss. Look at this. Once that stop loss triggered, big crash. So this is the candle you will short. Okay, not this, not anywhere else, because you will wait for stop loss to get triggered. How retailers get trapped, how novice trader get trapped. Any novice trader or retail trader who look at this green candle, first thing he comes to his mind, I should buy because of the bullish candle. It will go up. But what happened? Reversed, right? And where you will short? You will short this candle because people had the stop loss. So you can see that free fall after that. So that is what known as stop loss hunting, where and how people keep the stop loss. So that is what about all the 15 patterns, how you should trade. And I shown you that all the 15 patterns, how price action is supreme, how price action most of the time works so nicely. Not all the time, nothing works all the time, but price action, pivot point, CPR can help you many times. Okay, so trading is all about patience, waiting until you see the setup, until you see the patterns. So go through all the chart patterns, everything what I have mentioned here. You will also get the ebook along with the course materials. In that ebook also I mentioned everything in much clearer, all the 15 patterns and strategies explained in much clearer, like how I mentioned here. That also you can refer. And how you will learn very fast all these patterns, you have to do the back testing. Any patterns, any strategies, wherever you learn, never trade immediately because you learned it. You have to do back testing. When you do the back testing, you will get the confidence. And in the live market, when you take the trade, you will feel confident enough to take that trade. So that is why my advice is start doing the back testing on historical charts. I have around 2 years of historical charts on 5 minutes time frame on Nifty, Bank Nifty. These patterns I back tested on Nifty, Bank Nifty. You can also back test on Nifty, Bank Nifty. I have not tried on commodities, stocks, forex, and all this. Okay, so if you are trading in commodities, forex, stocks, then you have to do back testing. You have to do the back testing and then only apply it. If you want to do back testing on historical charts, you can send me a request email requesting for historical charts. I can share that Google Drive link where there are around 2 years historical charts of Nifty, Bank Nifty available. And remember, when you do the back testing, if any patterns, for example, green candle breakout, oh, last month 2 times it failed, that doesn't mean that that pattern has failed. Okay, I said nothing works 100% of the time, just anything works 50% of the time, still it's a good strategy, because risk reward is more important, right? 1:2 risk reward, even 50% win rate also can make you profitable trader. So this all probability, there is nothing like 100%, and anything worked previously, then there is a very high chance that it can work in future also. Okay, with that, we are done with all the 15 patterns and strategies.